Imagine you walk into your local bank branch on a Tuesday morning. You aren't there to apply for a loan or complain about a late fee. You are there to simply move some money. The teller looks at your screen and suddenly their posture changes. They stop looking at you like a retail customer and start looking at you like a high-value asset at risk. There is a specific line in the banking industry that separates the customers they profit from and the customers they have to compete for. And while $20,000 is the threshold for resilience and $25,000 is the point where internal algorithms reclassify your status, $50,000 is the number that officially breaks the bank's traditional business model. Today, we are going to perform a forensic audit on the secret operating procedures of the financial system. We are going to look at why a $50,000 balance makes your bank manager lose sleep, how it triggers a cascade of internal shifts in underwriting and fee waiver protocols, and why the banking industry has spent millions of dollars designing digital interfaces specifically to keep you from realizing how much power that number actually gives you. Because the bank is not your friend. The bank is a business with shareholders, and their most profitable product is your financial inertia. To understand why $50,000 is so dangerous to a bank, we have to look at how they actually make money. Most people assume banks make their profits from interest on big corporate loans or complex Wall Street trades. But the engine room of retail banking is something called net interest margin, or NIM. This is the spread. A bank essentially borrows money from you via your savings account at a rate of, say, 0.40% to 0.60% annually. Then, they take that same capital and lend it back to your neighbor in the form of an auto loan at 8%, a mortgage at 7%, or a credit card balance at 22%. The spread between what they pay you for your capital and what they charge others to use it is their entire world. When you have $2,000 in your account, you are donating your capital to the bank's spread. You don't care about the yield because 0.50% on $2,000 is only $10 a year. It is not worth the effort to move. The bank knows this. They rely on your financial inertia, the psychological friction that keeps you from opening a new account at a different institution. But at $50,000, the math stops being a rounding error and starts being a mortgage payment. $50,000 at a standard bank's 0.05% rate earns you just $25 a year. That same $50,000 in a high-yield savings account or a treasury money market fund at 5% earns you $2,500 a year. That is a $2,475 difference. It is a family vacation. It is a massive chunk of your property taxes. The $50,000 mark is the psychological breaking point where inertia dies and yield sensitivity begins. Banks know that a customer with $50,000 is a flight risk deposit. They know you are one Google search away from realizing they are extracting thousands of dollars of value from your inertia every single year. Furthermore, banks use internal account profitability models that categorize customers based on how much they can be extracted. Customers with low balances and minimal savings are often labeled as high engagement accounts. In corporate speak, that means they are the people who pay the most fees. According to the Consumer Financial Protection Bureau, banks collect billions in overdraft and maintenance fees every year, but roughly 80% of those fees are paid by just 9% of account holders. The ideal customer for a bank isn't a millionaire. Wealthy people barely interact with retail banking. They have private bankers and treasury ladders. The ideal customer is someone earning a decent salary but living with under $20,000 in liquid savings. That person is almost okay, stretched enough to occasionally overdraft, worried enough to never walk away from the bank's products, and productive enough to keep earning money to pay the tolls. $50,000 is the number that builds your own bridge. The moment you cross it, you exit the toll road economy. You stop being a source of revenue and start being a liability to their margin. At $50,000, the bank is legally and structurally forced to treat you differently. You trigger a series of internal shifts in underwriting algorithms that change your status from a retail consumer to a preferred entity. Once that status changes, the bank has to stop charging you for their services and start paying you to keep your business. This status shift isn't just about getting a premier label on your debit card. It changes the actual price of your life. For most lenders, a borrower with $50,000 in liquid cash is statistically far less likely to default on a loan than someone with $5,000, even if their credit scores are identical. Why? Because $50,000 represents escape velocity. It covers the median American's mortgage, car payments, and utilities for over a year of total unemployment. In the eyes of the bank's risk model, you are no longer a standard risk. You are a low-probability loss. This status shift can be the difference between a 7.5% interest rate on a loan and a 5.5% rate. On a $40,000 loan, that status shift saves you thousands of dollars that the bank would have otherwise kept for itself. They don't want you to know that your cash is the ultimate credit score booster. They would rather you keep your cash small and your interest payments large. But once you understand the $50,000 rule, you realize that you aren't just a customer, you are the supplier of the raw material for their entire business. To understand the shift that happens at $50,000, we have to look at the negotiation surface. Imagine two people walking into a bank to dispute an unfair fee or negotiate a mortgage rate. Person A has $800 in their account. When they ask for a manager, the bank knows they have no leverage because most other institutions have minimums they cannot meet. The bank is polite but firm. The fee stays, and the rate is fixed. But then there is person B, with $50,000. The moment their profile is opened, the bank's internal churn model flags them as a high-value asset at risk. The branch manager knows that if this customer leaves, the branch's deposit goals for the entire quarter will take a measurable hit. Suddenly, the non-refundable fee disappears, and the fixed rate becomes flexible. This is the threshold where it becomes more expensive for the bank to lose you than to give you exactly what you want. This leads directly into the trap of privileged accounts. At most major institutions, $50,000 is the level where preferred or premier tiers officially unlock. These accounts are marketed as a reward for your loyalty, offering waived wire fees, reimbursed out-of-network ATM charges, and a dedicated relationship manager. However, from the bank's perspective, these accounts are a defensive perimeter. The bank is essentially saying they will stop charging you for the basic infrastructure of banking because they are terrified you will move that $50,000 to a competitor across the street. The $50,000 rule is the point where you officially stop subsidizing the bank's operating costs. If you are paying a $15 monthly maintenance fee while trying to build wealth, you are simply paying a tax for not having the $50,000 leverage yet. But the industry has learned a hard lesson about people with this level of liquidity. In the 2023 banking crisis, we saw the power of this threshold play out in a brutal way. When institutions like Silicon Valley Bank began to wobble, it was not the people with $500 who caused the panic. It was the people with $50,000 and above. They were the ones with the financial literacy to see the risk and the liquidity to move their capital instantly via a smartphone app. Because of this, banks in 2026 have redesigned their entire digital interfaces to slow you down. They have introduced what insiders call digital friction, security pauses, extra verification steps, and maintenance windows that conveniently appear when large sums are being moved. They know that if you understand your power, you are a flight risk deposit. They want you to feel like a member of the family through personalized marketing so that you will not act like a cold, rational capital allocator. They would rather you keep your cash small and your interest payments large. But once you hit 50,000, your identity in the system reclassifies. At 10,000, you feel safe. At 20,000, you feel disciplined. But at 50,000, you start to feel like an owner. You realize that you are the supplier of the raw material, capital, that the bank's entire business model depends on. Without your deposits, they have nothing to lend. But here is the most dangerous moment of all. The industry knows that for most people, $50,000 is not a destination, but a resting place. Banks understand that you are likely planning to use this capital for a major life event, like a down payment on a home or a new car. The moment you sign that check and drain your account back down to $5,000, you voluntarily move yourself back into the high-risk category. You give up your leverage exactly at the moment you've taken on your largest debt, returning to the cycle of high interest and monthly fees. To stay on the winning side and keep the system nervous, you must follow the sovereignty protocol. Step 1. The fee audit. If you are paying a bank even $15 a month for account maintenance or account infrastructure, you are on the wrong side of the rule. Move your money to a high-yield online institution or a local credit union today to recover that revenue for your own pile, not their dividend pool. Step 2. The yield capture. If your savings are earning less than the current market rate, which in 2026 sits around 5%, you are paying a tax on not knowing better. On $50,000, the difference between a standard savings rate and a high-yield account is over $2,400 a year. Literally, a free family vacation or a massive chunk of your property taxes. Step 3. The cash is credit strategy. The next time you apply for a loan, do not just show them your credit score. Force the loan officer to acknowledge your liquid reserves by asking, "I have $50,000 in liquid cash. How does this leverage affect my tiering?" If they won't lower your interest rate based on your resilience, walk across the street to a lender whose algorithm is designed to prize capital over just scores. Step 4. The threshold hold. When you hit this mark, do not celebrate by spending it. The true value of $50,000 is not what it can buy, but the permanent change in status it gives you within the financial system. Hold the line. Let the algorithms reclassify you as a preferred entity and use that leverage to lower every other cost in your life. By reaching this threshold, you have officially moved from being a retail consumer to a supplier of capital. You are now the supplier of the raw material the bank's entire business model depends on. When you see yourself this way, you stop asking, "What can I afford to buy?" and start asking, "What is the best internal rate of return for my capital?" This is the gateway to the 1% mindset. The bank is not your friend. They are a counterparty in a negotiation, and in every negotiation, the person with the most cash has the most power. You have built your own bridge. Now cross it and never look back at the toll road again. If this forensic audit of the banking system changed how you see your savings, hit that subscribe button. We are dissecting the hidden rules of money every week so you can stop being the product and start being the owner. I am Dave, and I will see you in the next one.